Thanks everyone for coming out tonight, and those joining us via live stream. This project that we're going to be presenting on tonight is the town's wastewater rate study update, or long-range financial plan. And we have with us tonight Jim Braziz from BMA Management Consulting, who undertook the rate study update for the town of Penetanguishene. And what we'll do tonight is Jim will go through the presentation and give an overview of the process that his firm took to update our rates, and have some time at the end of the presentation for comments and questions, and then we'll wrap up the night. So here's Jim Braziz.
Okay, thanks, Brian. Brian, which one? Oh, no.
Just use this one here.
Oh, okay. Thanks, Doc.
Yeah. And if you want to go back, you just do that.
Okay. Thanks again. In accordance with the Ontario regulations 45307, it requires municipalities that operate a water system to update a long-range financial plan. And the requirement is to be a 6-year financial plan, and it's one of the requirements to renew the license. So the town has taken a proactive approach. The regulation says that you have to do the long-range financial plan for waterworks only. But as I say, the town's taken a proactive approach, and they've also prepared a long-range financial plan for the wastewater operations. And as I said before, the plan is to cover 6 years, but the town has approached it over a 10-year period. The financial plan that I'm going to be showing you tonight, it's a dynamic document, and it's all based on, of course, it's a projection, so it's based on assumptions. So the recommendation is that as the assumptions change, and they're stated in the report, the report should be updated to match the new practicalities of the situation. So the guiding principles we use to establish the long-range financial plan: first of all, you want to make sure that there's sufficient funds to protect and maintain the water and wastewater assets. We want to make sure there's a reasonable degree of stability and predictability in the rate burden, so people know and have an expectation what the changes in rates would be. We want to also make sure that there's fair sharing in the distribution of resources between the current and future taxpayers. A lot of municipalities in the past, and not as much today, but postpone the replacement of assets, and they just kind of pushed that off to future generations. And that's in fact what's happening here in most municipalities in Ontario. There's an infrastructure gap, and it's because the infrastructure wasn't replaced on a timely basis. So now current taxpayers have to absorb those costs. We want to make sure there's sustainable cash flows in the operations. Want to make sure that there's financial flexibilities. You want to make sure that you have reserves in place to deal with emergency situations. And then the other thing is to maintain the programs and services at their current levels. So what we did is we started off looking at the Penetanguishene water and sewer rates, and you can see from this chart, and we compared it to a number of different municipalities, a lot of surrounding municipalities and municipalities with similar populations. And you can see from this chart that Penetanguishene, the residential, which was based on an average residential consumption of 200 cubic meters a year, they're paying right now $1,010, and the peer average is $1,198. So it's about 15%, 16% lower than the peer average. And then when you get into the commercial and industrial operations, and you can see that we did it based on different cubic meters from each of the commercial industrial operations, and they're about 5.6 to 8.8% below the peer average. So just to start off, what we did is we wanted to get an assessment of the current situation. And what we looked at is the net financial assets of the operations. And the net financial assets is essentially reserves less debt. And you can see from this chart, in terms of the water operations, there's $900,000. And that's essentially, they have a reserve balance. But when you get into the wastewater operations, there's about a $10.5 million negative net financial assets. The reserves is in a negative position as well. There was some debt issued for a very large project of and the debt outstanding is about $9.4 million. So the wastewater operations is about $10.5 million in negative balance. So what does that mean? That means that future wastewater rates have to come up with the cost of financing that $10.5 million. So in terms of the assumptions, when we built the projection, we assumed inflation would be about 2%. So our projections indicate that, again, to meet those guiding principles, in terms of the water, I just showed you that the net financial assets is a positive balance, so they can absorb the water operations over the next 3 years with a 0% increase, so no increase in the water operations. However, and then from after the first 3 years, about a 1% increase till 2028. In the wastewater operations, as I just mentioned, there's a negative net financial position, and I will show you in a few minutes, there's also large capital expenditures in terms of the capital budget on a go-forward basis. So to make up those costs and to make up that negative net financial position, it requires about a 6% increase between 2019 to 2022 and a 4% increase thereafter. One of the things that impact the rates is consumption. So basically, to calculate the rates, you take the total expenditures divided by the consumption to come up with a cost per cubic meter, if you like. And what we saw is, and the other thing too to keep in mind is, in terms of water and wastewater operations, they're very capital intensive. So even though consumption is decreasing, there's not a correlation between the decrease in consumption and what you can reduce the expenditures by, because there's tremendous amount of fixed assets. The fixed assets are generally 85 to 90% of the total operations. So consumption is important when you're establishing the rates. And as I say, residential consumption has been decreasing, as well as the industrial consumption. And there was a high school closure, which there was a loss of water associated with that. There was been reduced consumption at the hospital, and one of the major industrial properties, they are no longer. So there's a reduction in consumption. So on a go-forward basis, we realize that even though the consumption trend is going down, there is going to be growth. So our assumption is that what we'll do is, when calculating the rates, we project no increase in consumption on a go-forward basis. In terms of the rate structure, the Canadian Waterworks Association, they have said that there's a lot of variation in the rate setting practices. There's no standard across all of the municipalities on how to establish the rates. But at the heart of the methodology, the water and wastewater rates, they're set on basically on a two-part structure. There's a fixed component, which is based on meter size, and there's also a volumetric charge. And we did a survey of over 100 Ontario municipalities, and what we found is that 90% of the municipalities have the two-tiered rate structure, similar to Penetanguishene. In terms of the rate structure, the volumetric and the fixed, you're collecting about 76 to 78% from the volumetric side of it, and then the remainder from the fixed. And we recommend that that's a good mix between fixed and volumetric. We recommend that you continue with that 76% from the volumetric and about 24% from the fixed rate. The existing allocation, it supports the affordability objectives, because if you increase the fixed, a low volume, maybe low income household, they would be impacted negatively. So how your rate structure is and not changing it, it supports those affordability objectives. And there's also, it provides an adequate level of revenue stability because of the fixed portion that you're collecting. And the next important things in terms of the financial plan is looking at the reserves. And there's a requirement, or the purpose of the reserves, why you want to set the reserves, is to provide for rate stabilization. Because as I said, the consumption has been decreasing, and if you haven't built that into your forecast, you don't want to have a huge charge on future ratepayers, so you want some sort of reserve to stabilize the rates on a go-forward basis. It provides financing for one-time short-term requirements. Reserves are necessary for the replacement of assets that are currently being consumed. It avoids spikes in the funding requirements. It provides a source of internal financing, so you have reserves and you don't have to go out to market and issue debt to pay for the infrastructure renewal. And you need reserves for sustainable cash flow purposes. So they provide financial sustainability. So you can see from this chart in our forecast, this is showing the contributions to the capital reserves. And as I said, you need these capital reserves to pay for that replacement of the capital infrastructure. So that kind of that green line, you can see that in the forecast, the contributions to capital reserves are increasing over the forecast period. When you look at the water reserve, it's because we're not increasing the water for the first few years and only a minimal increase in the latter years. The water reserves are fairly flat throughout the piece. But as I said early in the presentation, that there is a reserve balance on hand. And then when you look at the wastewater operations, where there's that negative, you can see that we're increasing the contribution to capital reserves for wastewater. So in terms of the reserve strategy, you want to make sure that your infrastructure is in a state of good repair. And so we recommend, at a minimum, the town target setting aside a contribution to the water and wastewater reserve based on the annual amortization expense. Now that's a minimum, because the amortization expense is based on the historical value of the assets, what you purchase those assets for. But when it comes time to replace those assets, there's obviously inflationary increases, and they're going to be worth a lot more than when you originally put the assets in the ground. But as a minimum, we're saying that it should at least be equal to the amortization expense. And then you can see from this chart, in the beginning of the forecast period, your reserve contributions are less than the amortization costs. So we're targeting or ramping that up over the forecast period. And then by the end, it's very slightly more than the amortization expense. So by the end of the plan, in fact, I think it's year 8 of the plan, you would be matching that minimum. And then, as I say, the last 2 years is slightly higher. So the capital reserve balances, I showed you the balances, or I talked about the balances at the beginning. The wastewater capital reserves in a negative balance. The water reserve was in a positive balance. So when you look at the green line here, you can see from that's the combination of the wastewater and the water reserves. It's a positive throughout the forecast period, and it builds up to 2028. And then when you look at the wastewater operations, as I say, it's a negative, so we're gradually building that up to a positive balance toward the end of the forecast period. Debt strategies, you want to make sure that you use debt strategically. And so in terms of financial flexibility, your debt shouldn't be higher than 15% of your revenues. And this, as I say, maintains sufficient financial flexibility. Over that forecast period, we anticipate that you don't have to issue any more new debt over the next 10 years. And so as a result of that, your debt will be gradually going down as you're paying the principal each year. And over the forecast period, you're within that 10 to 15% range, which is the recommended range for financial flexibility. The capital budget, the capital replacement, this is the capital budget over the next 10 years. The little blue is the amounts that are growth-related. And those growth-related capital costs, they are contributions from the development charges. But the rest of it, the green, is the replacement costs of in your capital budget. And they're funded from the rates. And you can see that the capital budget is for water is about, funding from the rates requires about $2.75 million. And in the wastewater operations, from the rates, you have to generate about $2.6 million over the forecast period. This is probably a little bit hard to see, but based on that, those increases that I talked about, this is the impact on a residential consumer that uses 200 cubic meters a year. You can see from this chart on the far right-hand side, in 2018, the consumer paid $1,010. In 2019, based on the plan, it would be $1,046, so about a 3.6% increase. And then there, over the next 3 years, it's about 3.7, and 3.8. And then from then on, at the latter part of the forecast, the blended increase is about 3%. So at the end, you're paying $1,300 over the next 10 years. At the end of the 10 years, you're paying $1,395. And that's still within the existing range of those municipalities that I showed you up front. So that's the end of the presentation, and I'm happy to answer any questions. Thank you.
If there's any questions or clarifications that Jim or I can answer for you?
Well, we knew the sewage treatment plant upgrades was going to create the sewage cost increase.
That's what I assumed it was, the high rate was at when I got in with wastewater.
Yeah, that's right.
For the plant.
Is there any questions on any of the slides or the information that Jim presented?
No, I understood all of that, it's actually pretty good, and it's understandable, 3% over every year is not, it's not outrageous, that to still meet everything to be budgeted up and take out the cost. Especially when you're way over the amount of other municipalities.
Right.
For our size, it varies lower, really lower, but they're larger with more income, so you got more usage, which means you have more money coming in, so then your costs could be dropped down based on your numbers of coming in.
That's an excellent point, and that's exactly what happens. As I said, the costs are pretty much fixed, but if the consumption is the volume's a lot higher, it allows you to not charge as much. Yeah. Yeah.
Yep.
What about that, I'm not saying the right words, but on our water bill, we have fixed, we pay for the water we use, and then there's the surcharge for wastewater.
That's right.
And that's what you're proposing will increase by 3% each year.
The total bill would increase by 3%. Yeah.
What I understood is we will have our water in will not change in the next 3 years. We'll get an increase on our surcharge, our water out by three, and then it'd be like 2.5 for the out and 1 for the in, so if we will balance out, it'd be about 3 points all the way through. So it'll be 3 points every year, but it'll just be done in different stages,
That's right.
which covers all capitals and whichever else. It all makes sense, and I see why
3% is very justified. I can remember water reports that came to us in Vernon. They were looking for 6%, and sometimes even more.
Yeah.
Remember those, we sent them back, though.
No kidding about it.
I'm fortunate, I live in a part of town where I'm septic, and I get my water comes from the well across the street.
There.
It costs me $90 for 3 months for my water.
I actually lived in Pine with a well and septic, and it was about to be my hydrant.
But then again, when the pump goes, it was $1,000 then, so it's all,
Yeah.
Balance.
and then when the septic has to be changed, there's that, so it's all relative.
So, if there's any comments or questions, yeah, please, if you don't want to say now, or you can always email me, and I can let Jim know, and we can clarify anything. Jim's going to be back next week for our committee of the whole.
I was just going to ask,
Meeting.
where does this go now?
Yeah, and he'll do a presentation under the presentation section of the committee of the whole.
What is this community of the whole?
We have our council meeting twice a month,
Right.
and after our council meetings, there is a committee of the whole meeting, so they actually do 2 meetings in one night. So the council meeting will deal, it starts at 7 o'clock, and it'll deal with the items that were passed by committee the previous 2 weeks ago. And then after that's done, we'll go into committee, which will deal with new items that'll get approved at the following council meeting. And that's how our system. That's correct. And it'll be this presentation. Yeah. And then I have a covering report in the report section of the agenda.
So that will be a committee of the whole, and then 2 weeks later, we will pass it, or one meeting week March,
Yeah, that's right.
before it'll be ratified.
That's right. So we're, the plan was to get it approved in early March so that we can use the new rates for the first quarter billing.
For the first quarter billing?
Yep.
So we're gonna be billed, we're gonna be reconciled as of the 1st of March.
Yeah, as of January 1st to March 31st for the first quarter, it'll be under these new rates.
Yeah, so we're
Yeah.
gonna, yeah. Very good.
Thank you.
Okay, thank you.
Good, well, hey, that wasn't all that bad, was it?
You know, Charlie, just take over and stuff, and finish the road.
Just unfortunately, we don't get more public showing up.
Yes.
This is disappointing, really.
Yes.
Yeah, this,
You're optimistic if you see what.
well, yeah, well, you figured maybe 10 or 12 people. I mean, the town's got 6,000 people in it, right? You figured 10 or 12 would show up.
We have 9.
9,000, okay. well,
And we have 444 residential homes. 4,000.
4,000 homes.
Yeah.
When they get their first bill, they say, what's going on here?
Yeah.
That's the problem.
Yeah, that's the problem.
Nice meeting you.
Nice meeting